I'm Ethan Devitt, and welcome to this week's Markets Happy Hour podcast. I'm recording this on Thursday, the 13th of August. It's in the late afternoon, and I'm delighted to be joined here by Simon Evan Cook, who is a well-known LinkedIn personality, strategist, and multi-asset manager at Downing Fund. Welcome, Simon. Thanks for joining us here.
My pleasure. Glad to be here.
Well, you have a lot to say on your various articles and your blog and your LinkedIn, so I'm really looking forward to getting your contributions here. So, with no further ado, let's bring up the slides.
Great.
I've called this week's podcast Earning Their Keep, as when it comes to equity market direction, we are very much still speaking about earnings. But the good news on a global scale is that earnings are not just US exceptional anymore. We're seeing earnings across global markets. So that is a positive trend. The picture I've used is of the eclipse that many in Spain, for example, were lucky to see yesterday. I didn't see much of it myself, but it was, I think, one of those moments that brought people together and was quite a spectacle by all accounts. As usual, we're going to cycle through 5 topics: inflation, interest rates, equity markets, geopolitics, and general vibes in markets. That's why I mentioned that, because I'm sure Simon has something to say about some recent volatility, and then other asset classes such as commodities if we have some time. Some of the subtopics, obviously, we've had some jobs numbers, we've had some inflation numbers just this week. Wanted to reflect again on the yen intervention and what that means about the global financial system, how it's hanging together. We have a couple of observations on equity market volatility, looking at some trades that may in fact be the anti-tech trade. And we also have a little bit more clarity about private credit as the cycle moves on. So here's Simon, as I mentioned, multi-asset fund manager at Downing Fund Managers. He writes the Fund of Funds Insider column for Citywire. So Simon, let's get straight into it. So inflation, we've had a number out of the US, overall 3.4, core 2.5, a bit like June in the sense that it did look somewhat flatter than maybe what Main Street would have you think in terms of the effect of inflation. We know that copper as a commodity continues to drive on the supply side, and that oil with the Strait of Hormuz developments continues to drive there. So where are you coming out on these inflation numbers? Cause for concern or not? And maybe then we can talk about where it leads with interest rates.
Yeah, so I mean, it's probably worth me saying up front that I'm very much a kind of long view type of guy on all this. I heard someone say once that you can zoom in and obsess or zoom out and observe, and I'm very much the latter. I'm a kind of observer. I've got a long-term view, very firm long-term view on all of these matters, and I haven't seen anything in these data releases that makes me want to change that in any way. On a bigger scale, I mean, if you bring it in about as close as I want to come, short term as I'll come, it does feel a little bit economically like there's a little bit of sogginess out there, a little bit of maybe kind of slowing happening. Now, obviously, I've got a slight UK bias because that's where I'm based, and it feels a little bit, what with the housing market feeling a little bit soggy and the general sentiment, everything feels soggy here currently except the weather, which is unseasonably hot, which is worrying in its own way, I guess. But generally speaking, yeah, if you're looking for a shorter term concern, I would suggest that a lot of this data points to, yeah, a slight slowdown in activity. That lower inflation might, instead of being good news, might be something that is actually suggesting that we're beginning to see economic activity tailing off. So I would take it as a concern, but dragging it back to my favorite view, which is the long term always. What I'm more concerned about is inflation rising longer term. And I think you can obsess about the details and the monthly prints and what copper's doing as much as you like. But when you zoom out and look at the big picture, that is unavoidably that there is too much debt
Yeah.
in the world today. And much as we sort of flip around trying to get around that problem and find ways of igniting growth without having to pay off some of that debt, at some point you're going to have to pay the piper for
Yeah.
that. And I think when you look at all the alternatives, it's interesting. Most commentators kind of agree on this, that really the only way this problem is going to get solved in the long term is through by inflating it away. The
Yeah.
alternatives to that are just not palatable to politicians, but it feels a little bit to me like most politicians are trying to beat around the bush. They don't want to do the inflating away on their particular watch, so they're kind of kicking the can
Yeah.
down the road. But I think eventually all of this has to add up to higher inflation. So when you look in our portfolios, we are shorter duration than average. We're not zero duration, not like we were back in 22, where we had no bonds whatsoever in our bond portfolio. But now we have some bonds because we can see there might be periods, shorter periods where possibly we're looking at one where there's more of a deflationary short-term trend.
Mm.
But over the next 10 years or so, if you could only pick one position, we'd be very much the sort of inflation trade, the fact that you want to be slightly shorter duration and in the kind of assets that might protect you against that.
Well, that's very interesting. And I think we'll come back to that point when we start looking at the yen intervention, like what was really driving that. And was it the fact that there's so much ownership by Japan of US treasuries? And if we are kind of in this delicate balance of who's owning the debt, and we know the pricing of the debt can get kind of precarious as well. There's certainly, I think, it doesn't, it's never a main character, this fiscal budget situation in our discussions, but is very much lurking in the background. And
Yes,
it
it
takes
is
some time to
always,
before.
always.
Yeah. Well, a couple of other in terms of economic vibes. So I have clearly the oil prices, which have been moving around, probably the most volatile responders to the Strait of Hormuz developments, and then the jobs messaging that we had. And interesting in terms of your deflationary short-term suggestion, it does seem sometimes that inflation expectations seem to be lower than the headline would suggest. And when it comes to the jobs numbers, looking at a US jobs number here, we don't seem to get as much frequent data around the non-US, but the companies aren't hiring, but they're not firing either. So it didn't seem to be, we had this low hiring, low firing kind of
Mm.
equilibrium before. It's interesting whether this is telling us much about the health. It's not particularly robust indicator, but in terms of other economic vibes, what do you look at? I mean, even in the long term, consumer
Uh,
sentiment?
well, in the UK, it's definitely property prices, and the market here certainly feels like it's stagnating.
Mm.
We've had a very long cycle. And, when you are talking about long cycles and long view, there is certainly a view that you get these very long cycles in property, and we've had one for a long time now. And we are seeing that slow down a little bit. There's not a lot of activity happening. People aren't moving house as much as they could do. There are structural problems there where possibly the baby boom generation might like to downsize, but there are tax issues to doing that. And then at the same time, with interest rates higher than they have been for the previous decade, the younger generation, I just don't think are simply able to step up and pay the prices. So we've got that, and that is such a huge impact to the British psyche that I think it's quite hard to get beyond that. Um, Other than that, yeah, we were discussing earlier. My son's just done his A levels and about to go off to university, and the big worry there
Congratulations.
is that, yeah,
Yeah.
thank you, is that when he comes out of university, again, very much the anecdotal evidence seems to be that it's very much harder for younger people to find jobs and good jobs, and that comes back to AI, which is another one of those longer term pictures of we've all seen what it can do. It's like having an amazing intern, a willing, keen intern with unbelievable depth of knowledge. So it's very easy to just say, should we not hire a young intake this year and see how we get on with using AI to replace them? I think that stores up problems for the longer term for society as much as an economy, but it does hint at that bigger problem, that bigger longer term problem of what does AI mean? Yes, it's going to make us all more efficient, but if unemployment spikes heavily on the back of that, then does that actually outweigh all those benefits because, you know, there simply aren't enough people in jobs to actually be able to buy your goods anymore?
And it's interesting. I did have some slides about the property market last week about showing how some flats have actually fallen in value. It goes completely against people might have thought of their real asset, their property, as being a good inflation hedge. It's been absolutely complete opposite if it's falling in value. Certainly in real terms, it would have fallen. And then we also have as you mentioned, that this divergence on the one hand, the concern around jobs, and on the other hand, Anthropic coming to London and paying apparently average salary of 600K. So something that completely blows the competition out of the water and makes it
I'm in the wrong industry. That's what that
I think
tells
we
me.
all are. We all are. So I mean, clearly mixed messages. I wanted to put one slide up about the yen intervention as I kind of skirted over it last week, because I think it's significant as we talk about deglobalization. Yet we also recognize that we are a global system and systems thinking is unavoidable. And when Japan sneezes or catches a cold, we can have these kind of effects across the global system. We've already seen that when there's an unwind of the carry trade, because that's happened to the yen carry trade a few times. And we know that there is this holding of US treasuries by country, this chart in the top right showing how much is held by Japan. So clearly, if Japan is to sell that, that could cause some kind of issues around the US Treasury market. And then clearly even the intervention, the boost didn't really do much. That there was a brief rally of the yen and it's kind of has petered out ever since. So I'd love to think whether you think that this is something significant on the global system stage, this yen intervention by Besant, and the fact that it was needed. And what does that say about maybe how fragile the global systems are?
Yeah, it's a really interesting area, the yen. We've got some yen exposure. So when we look at our portfolio, we separate the equities very clearly from everything else. So our growth assets, equities, our defense assets, effectively for us, it's bonds from developed market countries. You go back a few years, we had half of that was in dollars. Now we have 2.5% because it's more expensive and we don't particularly like the risks, what's political risks. I mean, it's the first time probably in either of our lifetimes we've had to worry about that US political risk. So we've spread our exposure far and wide, and our biggest single exposure outside of sterling, because our investors are UK, is in the yen.
Mm.
And there are a lot of reasons for that. One is simply the valuation. Again, when you look at long cycles, and we've seen this before, and I remember one playing out a while ago, 12 years or so, when that changes, it's an incredibly powerful force. And if you're the wrong side of it, it's horrible. If you're the right side of it, then you can make very good money from that. And the yen has been weak and weakening for a long time now. And the recent activity has drawn a lot of attention to that, got it a lot of news. But I broadly think it's a positive thing. I think the Japanese possibly had enough of importing inflation.
Mm.
And at the same time, we know that Donald loves the thought of a weak currency. So if he can encourage anyone else to strengthen their currency and that might weaken the dollar, he's going to be all for that. So in terms of holding yen, I don't think there's anything that we didn't already know that's happened in the last few weeks, other than the big action that changes anything. I think it's a very positive move for the yen because it suggests now that, firstly, if you're going to try and go against that trade, you're potentially not just fighting the BOJ now, but you're fighting the Fed as well. And we know that you do that at your own peril. But also that the Japanese government now have probably said this is weak enough and we want this to strengthen from here. And I don't believe that the Japanese economy and the Japanese fiscal situation is as weak as people imagine. It's actually improved reasonably over the last few years or so. So, yeah, it's not something that worries me a great deal. And I think actually, if anything, I think it's positive for the yen.
Yeah. Well, then, now that's a great discussion. I think it is certainly coming to at a point when this deglobalization is being questioned. I mean, no country is an island, no stock market is an island. I think it's good a segue into the equity markets and what's been happening in the past week. They seem to have loosened up again in the sense that they are now kind of back to the positive side of the AI story. Microsoft's earnings, again, a lot of it's driven by earnings, the backward looking effect of that. It's implied volatility relatively low, which I think is interesting given some of the moves that we've seen. And then furthermore, if we look at just is all volatility low, I think the important thing to note is that these sectors such as chips can actually have quite accentuated volatility more than the broader market. And this is a kind of an interesting question that a lot of strategists have been thinking about. If we're seeing general stock market volatility low, but certain sectors that are incredibly popular and part of the momentum trade looking a lot more volatile, what does that say about what we can expect from an equity allocation? You're a multi-asset strategist. Have you thought about the equity piece having a different risk reward profile now because of these kind of pockets of volatility than maybe it did in the past?
I literally don't think about anything else. I mean, it's interesting. Like you've mentioned how the market has sort of firmed up and cheered up over the last week, 2 weeks or so. I'm actually quite gutted about that because the previous month when markets are selling off, that's been literally the best month of the last 3 years for my strategy and for my funds because we're diversified. It's as
Yeah.
simple as that. We do hold some AI exposure, but I think we hold what I believe to be a reasonable amount that you should be holding in a diversified portfolio. We only use active fund managers, and we only use the most active fund managers who are the most concerned with valuation, fundamentals, all of that boring stuff that people think is completely square nowadays. But that's all of our fund managers do. So we've had a tough 3 years in relative terms, our equity portfolio, because we haven't had that exposure that you've got in the index to the AI trade, to the hyperscalers, to US mega caps, all of that stuff that's been doing really well. But in the last month, we got our proof statement because
Yeah.
all I'm saying to people is when you look at the global equity market, it's not hard to invest nowadays and believe that you can make 10% a year for the next 10 years, but you will have to do something about it because
Yeah.
if you are simply holding a global equity tracker, which is loaded up on this trade now, I think you will struggle to just about make positive real returns over the next 10 years based on what you're paying for all of that. So there's plenty of amazing opportunities out there,
Mm.
but you've got within the market itself this incredible divergence. At one end, the mega cap end, US, AI, you are having to pay up a lot for that and take on massive risks for doing that and incur the volatility of that as well, by the way.
Yeah.
If you're prepared to go into European small caps, Japan, Asia, anywhere else, pretty much, there's no problem in the
Yeah.
stock market whatsoever. You can buy all sorts of amazing companies at perfectly reasonable and even super cheap prices and not be taking the same level of risk as well. So I'm scratching my head as to why people are worrying about all of this. So the cost of doing that in terms of what you've had to endure if you've been unlucky enough to have bought my 100% equity fund, for example, is that we've only made you 11% per year over the 3 years of its life,
Yeah.
which is basically what I'm aiming to achieve over a 20-year period anyway. If I can do somewhere between 10 and 15% for 20 years, I would imagine my client's going to be pretty happy. And some of them are, but the ones who are looking at the benchmark are getting a bit impatient because the benchmark's done 13, 14% over the
Yeah.
last few years. The difference being that I think when you're fishing in the waters we are, we've got sustainable stocks. I think the other waters have been deeply, deeply overfished, and that's a concern. The final thing I'd just say on that as well, in terms of volatility, is that, yeah, in our part of the world where we've got this mixed portfolio of small caps, small cap value, small cap growth, 37 different highly active equity strategies in one portfolio, we currently rank, if you look in the IA global sector, fourth out of about 550 funds for volatility.
Mm.
And the three above us all have the term minimum volatility in their title. So that's specifically what they're trying to do. I'm not trying to focus on volatility. I'm just trying to do the old school stuff of buying great companies at a cheap price. And it's a very, very calm ride doing that,
Yeah.
particularly when you look at what's going on at the top of markets or you look at what's happened in Korea in the past couple of weeks or so, where it just seems to be an absolute bun fight.
Yeah, well, I'm missing the slides here that I had last week, and a couple of things about the Europe being the anti-tech index. But I do have one down here. A couple of things just to support what you've said. I'll go through them very quickly. One is around the strength of earnings, and I mentioned at the very beginning that it hasn't just been the US. That's where the attention has been, but actually on emerging markets, Euro area, UK, Japan have actually had respectable
Yeah.
earnings growth. And that in the old days before we got into the outlandish territory would have been perfectly respectable. And then in terms of anti-tech trades, I mentioned the entire Europe being looked at as an anti-tech trade as if that was a bad thing, when actually I would probably more lean on your side that I think that's a good thing because there have to be broader trades than mere tech, and a diversified portfolio ideally fires on all cylinders and has got these correlation benefits and some negative correlation. This one happens to be picking on healthcare and showing just how healthcare did really prove itself in this is really a 6 week period leading up to the recent rally, but obviously a longer period going back. semiconductors have vastly outstripped there, but healthcare has been a nice defensive trade. So again, another vote for having the
And
the
it's
balanced
interesting,
portfolio.
isn't it? Because you go back a few years and healthcare was certainly flavor of the month because of that amazing story that used to be attached to it of demographics. We're
Yeah.
all getting older, our societies are getting older. So healthcare in theory should be an absolutely fantastic place to invest. It's just that everyone's got bored with that story
Yeah.
and has wandered off to find the next big thing. And yeah, 2 years, 3 years time, that story will be back and everyone will be excited about it again and healthcare will be off. And so you see these cycles play out, but yeah, there is a hell of a lot of stuff you can buy that is got the strong earnings that you mentioned, has got cheaper valuations. I just don't get why you would need to have a problem. And you mentioned at the start, I wrote a piece about the hedge fund, the situational awareness blowing up a few weeks back. And that it seems to be that might have been the thing that was bugging markets a few weeks back because it was so big and so leveraged that it was causing those issues. But the point is that leveraged hedge fund was causing problems for the whole index because of how concentrated that index has become. So it's possible to get away from that, but you can't do that by buying a global index or the S&P 500 anymore. You can still do it using trackers or passive funds, but you will need to find very different exposures to the ones that have won over the last 10 to 15 years.
Exactly. And it's funny that I've referred to this summer as the summer of deja vu because we certainly had our geopolitics rearing its head multiple times, the same story, as well as tariffs rearing their head. And I do think that this was going a little bit farther back, having the situational awareness blow up, bringing us right back to '08 or even '98 in the case of
Oh, with
LTCM.
LTCM and the like. Yeah, yeah.
Very unpleasant deja vu in that case. And then just to segue into the to some of the discussion around private credit, I think it is. Let's go back to the hyperscalers briefly because clearly a lot of the jitters, not only maybe the trigger, the problems for situational awareness was around cash flow. And some of these hyperscalers dipping into negative cash flows. And I don't have the chart here that shows everyone who's in a negative cash flow, but it isn't just Alphabet anymore in terms of net negative cash flow. We are seeing this massive expenditure and the fact that their free cash flow has been sinking to below their chat GPT era. So clearly they do have deep pockets, these firms, but only to a point. And that requires them, therefore, to issue to debt in order to finance this expenditure. And what we can see here is a spread widening on investment grade hyperscaler spreads. So it's getting more, people are demanding more to lend to the hyperscalers. And clearly the data centers and neoclouds are in a similar situation. So what does this tell you? Does this give you confidence that the financial providers are not just lending no matter what? They're actually still reminding themselves of the need to do proper credit checks and to hold out when it comes to this type of speculative finance.
I think it's interesting because I'm a fan of equities. So first and foremost, if you pick an asset class for me, it's equities. But that said, I kind of trust the credit analysts and the bond analysts a little bit more than a lot of the equity analysts sometimes. And I think this is showing you the reality of the risk going up in these companies because they did have incredibly deep pockets, like you said, extraordinary cash flow and cash to fall back on. So they were an incredibly safe bet. You saw that with the Iran war earlier when, they were the kind of safety, the safe haven trade. But they're going to have to spend that money and they are spending that money and they're going to borrow more and more and more. And so it's right that their cost of borrowing should rise. And this will be an interesting market to watch because people have been lapping up credit for years now to the point where spreads are at almost all-time levels of narrowness. But there's a lot of supply coming through from this entire trade. So it'll be interesting to see whether there's some indigestion that comes up from that. Because again, when you look at the trades that have been a bit of the pain in the neck for us, we don't own any credit. And that's a structural position for us because we own what we own in the non-equity part. We want to go up in a sell-off, in an equity sell-off, and credit, it might fall less than equity, but more often than not, it kind of joins in eventually with an equity market sell-off. So we have a structural position there. But even if I was allowed to buy credit today, I would not be buying credit because of those very, very narrow spreads. To then chuck a whole load of more supply at these markets, it'll be interesting for me to be watching that from the sidelines. Let's put it that way.
And I think you're not alone. As my last slide here is around someone trying to make sense of what's going on in private credit, because it is an opaque area. A can be kicked down the road. There can be extending, pretending, amending. And I think it's interesting to look at some of the listed funds here: Ares, Blue Owl, Blackstone, Golub, KKR, and just to see how their total return has really been falling, in some cases quite particularly. I think it's also interesting to see not only the rising defaults. I think our defaults are still nowhere close to the '08 deja vu, so we're not quite being triggered in that way, but they are ticking upwards. I think what's probably more important is that layer beneath the actual default, that performing below expectations, the watch list, the trigger, that is seems to be getting wider. If we look at this chart on the far right, the top right, in terms of just the percentage of loans that are performing below expectations, has been as high as 15% in recent years, and is heading north again. And then we can also see that the listed private credit stocks have been reflecting this kind of, I suppose, this bit of a murky picture. So I think you're perhaps sitting on the sidelines, but it's true that there are many also still seeking to exit this asset class. And as we can see from the stock price, this has not been resolved yet in terms of where this credit picture sits.
Yeah, the popcorn's in the microwave for us on this one. We'll watch from interest from the sidelines, and it's the liquidity issue, isn't it, with these things where if something does go wrong, they're going to be longer to reflect that. Yeah, I'm quite happy to not have any exposure to this part of the world at the current time. Who knows what happens? Maybe there's no problem and they get through it. But to me, this I wouldn't be buying in now, even if I could.
Well, my last question, as my disclaimer appears, is around this long-term, short-term divide that you see. I mean, you mentioned you're a long-term thinker. It does seem that based on some of certainly the hyperscaler momentum, that cycles are getting a lot shorter, and there is sometimes a need to react to short-term news because, as we've seen, sectors can really massively expand, and market caps can really inflate. Do you think that have you had to modify your long-term approach at all over the last 5 years? Do you think it still applies in the same way?
Not particularly. I mean, it's probably worth mentioning a little nuance of what we do, which is that I'm relatively hands off, particularly on the equity side, which is where a lot of this stuff applies more to what we do. And from that point perspective, the fact that we've got 37 different fund managers making those decisions, what's interesting from my perspective is to see what they're doing in response to this, but because that market has changed unbelievably over the last 25 years in terms of those cycles. And what that's been driven by is the absence of active fund managers as the driving force of those markets. They're now minority investors in those. And a lot of the conversations I've had with those brilliant investors has been that they are now very aware of that and are adjusting their own behaviors to reflect that. So what they're seeing is previously when a company they've been watching too expensive but they liked was falling, they might have bought in sooner. Now they're waiting because they're seeing that when this momentum turns, it goes harder, longer. And the fact that they're now waiting means that actually there is potential for that to even fall further. So active managers are generally adapting their behavior to this brave new world that we're in and waiting longer before they start buying because there's not the competition for those cheap stocks that there used to be. It's really, really interesting the changes we're seeing. I don't know if you caught. So Terry Smith wrote his 6 monthly letter a few weeks ago, and he quoted a piece I'd written for Substack substantially, and it was interesting to see him drop his "do nothing" mantra, which is in the UK certainly the famous thing that, and it really dictated that period of 10 years where equity managers could just buy the best companies and then just leave them.
Mm.
That has kind of gone out of the window now because stocks are moving. You are getting volatility, differentiation between different stocks, and the ones that have been winning over the last 5 years are turning over their portfolio a lot more quickly. It's a
Yeah.
very, very interesting change, and I think fund managers are beginning to adapt to that. And therefore, our portfolio is without me having to do anything, which is exactly how I like it.
Well, I think it sounds like we're putting the active back in active management. So I will leave it there. Well, thank you so much, Simon. Fantastic breadth of views, and thank you everyone for joining us on this week's Markets Happy Hour podcast.